Let's see a Bayer Corporation use a periodic inventory system. The company had the following transactions in April. April 3rd, the Bayer Corporation purchased the merchandise from Salor Corporation for $30,300. The term is in 30 days paid. FOB is for shipping point. The Salor Corporation expect 15% of merchandise to be returned by the buyer. So let's see the journal entries for buyer and seller on April 3rd. So for periodical inventory system, you have the account called purchase account. Whenever the buyer purchase, you debit purchase, credit accounts payable. So for the amount of $30,300. So this is the difference from the perpetual inventory. For Salor's Corporation, you debit accounts receivable for $30,300. You credit sales. You credit refund liability because they are expecting 15% of the sales will be returned. Therefore, it's not earned. So when I calculate 15%, that's equal to $4,525. These are possible to be returned to the seller. Therefore, it's an unearned liability. We call it refund liability. And the difference is the sales. Now let's take a look at April 6th. The appropriate company paid the freight cost of $670 on the merchandise purchased on April 3rd. So this is the FOB shipping point. So the buyer is responsible for paying the transportation fee. So you debit the freight in expense. So $670, you credit cash $670. So the seller has nothing to do with this. Therefore, there's no entry for the seller. April 7th, purchased the supplies on account for $5,070. So you debit the supplies, $5,070, you credit accounts payable. Again, this is a transaction only for the buyer's corporation, has nothing to do with the seller's corporation. So no entry for sellers. April 8th, return the merchandise to the Salor Corporation and receive a credit of $3,800. The merchandise was refunded to the inventory for future resale. So for April 8th, so your accounts payable will be reduced by $3,800, and then you want to recognize this is a purchase return and allowance for $3,800. For the seller, the unearned liability, that's the account to consider the return. That balance is reduced by $3,800 because this is the actual return. So therefore, the receivable balance is also reduced by $3,800. April 30th, paid the amount due to Salor's Corporation in full. So April 30th, they want to pay off the owing. So we know that at the very beginning, the owing is $30,500 or $300. And then April 8th, there is a credit of $3,800. So the difference will be the owing is the $26,500. You have to use cash to settle this liability. The entry for the seller will be the opposite. You receive the cash, debit the cash, and you credit accounts receivable. So I hope this makes sense. Thanks for watching.